It's Wednesday, October 29th. The markets in New York are open, and our big number this morning is 188. That is how much the Dow shot up yesterday, ending the rally at just over 1,700 points. You're looking at a live picture of the New York Stock Exchange. Just a week ago, worried investors sent the Dow plunging. What a difference a week makes. Hello, everyone. I'm Michelle Franzen in New York, and here with the details, market analyst Jill Malandrino from TheStreet.com. So, Jill, over the past couple of weeks, Wall Street has been worried. Of course, we've been asking you over and over again, what is behind this volatility?
Good morning, Michelle. I think it's really interesting to note that the low in October was on October 15th when I was on with Dan. And the key that we were trying to drive home to investors was volatility is normal. A normal market functions on ups and downs. That's what creates averages. That's what opens up good opportunities to find some nice longer term fundamental buys. And that's exactly what you're seeing. So if investors kept their powder dry and remained calm, they're actually up 9% from that October 15th low, and that is why we really encourage people to embrace volatility, because that's what's going to make your averages, and you can find some good bargain hunting there.
And we're watching that those numbers are in positive territory at this hour. But could all of this come crashing down later today when the Federal Reserve announces an end to the monthly bond buying program?
Well, just to remind investors that over the past 4 or 5 years since we've introduced the quantitative easing program, that's where QE comes from, what the Fed has been doing is they've been applying bond purchases. It was $85 billion a month. They've been tapering. We're currently at $15 billion per month, and the expectation is for that to end this week. Now, markets don't like uncertainty. They like volatility, but they don't like longer term uncertainty. So one thing the Fed has been really good about is telegraphing each move that they're going to make very clearly. Yellen has done a great job doing that. So a lot of the uncertainty has been removed from the market because traders and investors know that the support the Fed has been injecting is coming out. And at the end of the day, that suggests that the economy is strong enough to support itself, and you don't need support from the Fed coming in. So longer term, that's a good thing. You might see an initial pullback following the FOMC rate decision at 2 p.m. Eastern. That's pretty normal. If you take a look at a couple charts, I've been reviewing some data over the past few days, you'll see that pullback. And with about an hour later, historically, you start to see a run up into the close of the market. So by the Fed pulling out, it shows our economy is stronger. I think it's good for longer term investors, and we're really able to support this market on our own via natural supply and demand.
And we're naturally in sort of that wild, wild west phase of this last quarter here. With the holiday season just a few short weeks away of kicking off, is it likely that the markets might just rally for the rest of 2014? What's it looking like?
Well, on a historical basis, there's that term called the Santa Claus rally, where you get a nice bid up into the end of the quarter and to round out the year. I think you can see a lot of positive momentum, and we're hearing this from corporate management and Wall Street analysts that the expectations for holiday 2014 in terms of retail stocks could be a nice gift for investors. Recall that oil has been historically low. It's certainly off its June highs, and that's good for the consumer. Less output to pay for gasoline, the more money you have in your pocket. That can mean a couple extra sweaters, another pair of sneakers. Maybe you can allocate some of those sources to travel, because that's lumped into retail as well. So I think you're going to see a lot of strength from your consumer discretionary retailers like a TJ Maxx, like a Ross Store, like a Macy's. And you can also probably find some good bargains among cruise lines, for example. They certainly got beat up with the Ebola scare. And now that costs are lower, there's some nice opportunity in there as well, and you're seeing that in the airline stocks as well. Consumers have more money in their pocket from lower gasoline prices, which means they can allocate it to discretionary items such as retail or travel, for example. So I think you're going to see a nice mix there. Speaking of oil, a lot of those stocks have been beaten up as well, and you might find some nice opportunity into them at the end of the year. Oil has certainly come back from that $79 low. It's just at about 83 right now. So while it got beat up 2 weeks ago, all those stocks, you could find some nice bargains where corporate management had super clean balance sheets, lots of cash on the books, well-performing assets, and now that the underlying oil is performing well again, if you locked in on some of those opportunities when they were less expensive, not only do you get cash returned to you in terms of dividends, you're getting paid to wait on some of these names. That could be a nice gift towards the end of the year as well. So I think you can find some great bargains in energy, some great bargains in retail, and some great bargains in travel right now.
And some great bargains, hopefully, from Wall Street to Main Street. Jill Malandrino from TheStreet.com, thank you for joining us.
Thank you, Michelle.
And you, of course, can keep up with the latest headlines right here on ABCNews.com. You've been watching The Big Number. I'm Michelle Franzen in New York.